This presentation is about the accounting equation, and it will illustrate first what it is and what it means to be in balance, and then secondly, and most importantly, it will illustrate how every single transaction that goes into the process of accounting is processed into that equation in such a way that it remains in balance. And now let's move to the accounting equation. So look at the three circles, or almost circles, there. You can see we have assets, and rather than define assets, we will define it later, but rather than define it now, let's just accept that an asset is something of value which the business owns. A liability, conversely, is an obligation that the business has to equip to some sort of external party, typically somebody who has loaned you money. An owner's or shareholder's equity describes the ownership, the source of the investment, the funds that are invested in the business by owners. Now, the logic of this is very simple. If you were about to start up a new business, and some of you will describe this in assignment 1, I know, you would have to work out that for your business, what are the assets which you need in order to go into business. And so those assets might, let's suppose, be a car, a truck, a computer, and perhaps some office furniture. Let's say you go out and do your research and you price up those and you decide that you can buy all of those assets for $50,000. Your next question then for this startup venture is, where is the money going to come from to buy those assets? Well, the money can come from only two generic sources. The first source is that the owners of the business will put in their own money, and when they do that, that's referred to as owners or shareholders' equity. Shareholders only if it's a company, by the way. Owners' equity is generic. However, many owners may not have enough money, or they may choose not to make the full investment, in which case they have to raise the rest of the money by borrowing. And typically they take their business plan to the bank, or perhaps to a business angel, and sell the benefits and the beauties of their business plan, the upside of course, and with a bit of luck and a bit of good planning, they would be made a loan. Now, loans have to be repaid, so they fall under the category of liability. That's an obligation to repay. And so typically the $50,000 of assets that you require might be funded by $20,000 from the owners and $30,000 from a debt provider. So 20,000 ownership plus 30,000 debt equals the 50,000 that you need in order to buy the assets to go into business. That is the accounting equation. That's what it means, and that's what it describes. It's no more complicated than that. And when we finish describing that, what I can tell you is that you have in front of you the structure of a balance sheet, the structure of every balance sheet for every business in the world. It's quite simple, isn't it? Okay, let's move on then. Armed with that information, let's look at what Anna Cox does when she starts her business. Her first transaction will be to put the funds, in this case $15,000, into a business bank account. So here's the next intuition that we have to be clear about. Every transaction in the accounting world has got two aspects to it. We refer to that as the duality of transactions. So with two parts to the transaction, we're able to keep that accounting equation in balance. Now that's our basic rule. The accounting equation, see that equal sign at the top of the green bit there? The accounting equation must always be in balance. If it's not, we've done something wrong. It's that simple. So Anna puts her money in, and it's $15,000, and that's registered as coming from Anna Cox. That's her capital injection, or her equity. What's the asset that results? Well, the asset that results is a bank account with $15,000 in it. And so our accounting equation remains in balance, and there you have the beginning of a balance sheet, where the assets in the business have been funded by the owner's equity provided by Anna Cox. Here's another transaction which is typical of a startup business. In this case, Sweet Temptations is organising the premises from which they're going to operate. Now, the information we're given tells us that she has to pay 6 months of rent in advance, and so that would total $6,600 based on the information above. In the Australian environment, that $6,600 comprises two elements, one of which is a prepayment of rent, and the other is the GST that Anna is required to pay. Now, to make that payment, Anna will have to draw cash out of the bank account, so the balance on cash will go down by $6,600, and the accounting equation records the fact that the cash went down, but it was used to pay for, in this case, two things: rent for 6 months in advance and some GST on the purchase. So notice again, the transaction has got a dual impact. The cash is drawn down, so that asset cash declines, and in doing that, Anna purchases two other new assets. So prepaid rent increases and GST increases, and if you look at the balances across the bottom, you can see that the accounting equation remains in balance as it must. Here's another transaction, purchasing supplies using cash. So again, you can see that the bank balance goes down by $770. They purchase supplies, so a supplies record goes up, and there's another $70 of GST. Notice that nothing's happening over here. Having put the capital in, that is a pretty still pond over there. Not much happens until we get to the end of the year and the owners get whatever profit or loss has been made. So mostly the action that we record will be in the liabilities and the assets section, and when we start trading, it'll be in expenses and revenues. Purchasing inventory now using credit. Now, credit is another liability. If we purchase something and use credit, then basically what we establish is an account payable, or some people will call that creditors. Creditors or accounts payable is a liability, and that's because it's an obligation to pay some money to somebody in the future. In this case, it's probably 30 days in the future. And so in making those supplies purchases, they are given here credit. Okay, we're told that it's 30 days. So 30 days from now, that $1,782 will be paid, but for the moment it won't be paid, but we have to record the obligation to pay. And once again, we can see that we've purchased items here of inventory, and once again, GST. The GST hits us coming and going. We'll learn that very quickly. Okay, so then here's this transaction here again, the duality, the liability has been increased, and the two assets here have been increased to maintain that balance. Let's quickly do. Okay, so there's another transaction. Spend some time looking through these transactions. Make sure to look at a couple more. It would be good for you to, in your own time, stop and make sure that you understand each of these transactions. In particular, understand the duality that always applies to every transaction, and understand that the reason for that is so that the accounting equation always remains in balance, by which we mean that little equals sign there is true, and that the sum total of all of the liabilities and all of the owner's equity will always be equal to the sum total of all of the assets. The next transaction here is purchasing shop equipment, okay, with cash and credit. Right, so they sell a desk for $440, and the hardware store agrees to pay for the desk on the 7th of January. Okay, so there we go again. We're collecting some GST this time because the transaction is going in the other way, and because they've sold it, the equipment goes out of the business, and because it's not going to be paid for another 30 days because they've given credit, they have an asset which is accounts receivable.